Okay, good afternoon, everyone. Thank you so much for taking the time out of your busy days to join us today. My name is Marcos, the portfolio manager here at Stock Specialist, and today we'll be talking about a highly requested sector that a lot of our investors and a lot of our clients, not just at Stock Specialist, but around the globe, have been querying whether we should actually be continuing to take a look at gold stocks, and particularly how exactly will it be a hedge against inflation going forward. So today we'll be divulging into a couple of those particular stocks that we've been recommending, and a couple of stocks that are actually outside of our portfolios that we're taking a look at quite closely, that we're seeing possibly a little bit of a potential growth, and that's exactly how we're going to beat inflation. So very interesting stuff, and we're going to take a quick look at all of those, but it will be quite a bit of a meatful. So please feel free. On the top right hand side of your screen, there is a speech bubble option as well, where you're able to ask any questions that you may have. That'll come through my team, and if we're able to get through them during this webinar, we will. If not, we will always answer them after the webinar as well, so that's okay. All right. So just a quick disclaimer, of course, as always, all advice provided within this webinar is just general advice only, under our AFSL there, of course. If you require any personal financial advice, please seek your financial advisor or relative broker. So today, just going through the agenda, we're going to take a look at the market movers, as always. There's always quite a lot going on within the markets, particularly within the beginning of this year. It's been quite tumultuous, and of course we're going to take a look at where the market is heading, and we've made quite a few forecasts on this over the last couple of webinars. If a few of our attendees have been taking a look at the previous webinars that we've been hosting, and we've made a couple of forecasts, and so far we've been pretty accurate, so that's pretty interesting part of the agenda as well. But of course, the three of our top stocks, particularly in the gold sector, and why we think they're going to be outsmarting inflation, and particularly why they're better than, say, the vast majority of the, your normal gold stocks that are purported by the various other analysts on the globe. And of course, we're going to run through our quick portfolio review of our portfolios and where to invest going forward through this year. So, as a quick start, 2023. This is something that particularly a lot of investors have been clamoring about, and is something that is on the highest of priorities and the highest of agendas, particularly out of the last couple of weeks, with US inflationary data coming out a lot higher than expected. They beat pretty much all economists and all analyst expectations, and that is, of course, flowed on to the effect that, well, basically the Federal Reserve will be increasing interest rates, and basically, well, further than what was previously anticipated. And now the terminal rate, currently based on the futures market, is currently sitting about 5.1%. So that's expectant of at least another 2 or 3 interest rate hikes coming out of the Federal Reserve. And inflation domestically actually decreased in Australia, but the equity market didn't necessarily respond quite so positively to that, and we'll touch on that a little bit later. So our base case scenario still for 2023 is basically identifying those points of inflection: interest rates, economic growth. We've seen the initial China reopening outside of the post the COVID zero policy give that initial boost up into the equity markets, particularly, but now it's a little bit sort of decimated. And now we're trying to figure out what exactly are we expecting going forward. It's quite a complex geopolitical backdrop. A lot of things going on, basically in every continent across the globe. So what are the catalysts that move it? As I said, inflation risks are the major component. We're hitting domestically still a month-on-month 7.8%. That was December. In January, the month-on-month inflation reduced to approximately 7.4%. Okay, which you would think would be largely positive. However, from our forecasts and the vast majority of analytics that have gone through a lot of this is particularly a lot of what they use primarily to measure is what's called core inflation. Core inflation is necessarily those pieces and those baskets of stocks and services, goods and services that are relatively inelastic to, general market moves. So the housing market, actually, which was the major concern, did of course decline slightly over the course of the last couple of months, and we are expecting that to be a key contributor to the decrease in inflation. But of course, that's not necessarily a key indicator of how the economy is performing, because the domestic housing market, of course, is highly contributed to, of course, the RBA increasing interest rates, and that, of course, will increase the default risk going forward. And that's an entirely different webinar, but it's something that we maintain quite a high focus on going forward. And what we've seen, particularly out of the last couple of weeks, is, of course, the earnings seasons, depending on what the company reports, whether it be financial year or calendar year. But regardless of that, a lot of key big players have missed earnings expectations. And when I say key players, I mean the actual key players. You can see companies such as BHP, Fortescue Metals, Rio, all missed earnings expectations and all reduced dividends. Not by a huge amount, but however, this was a catalyst, particularly for a lot of investors, which I mentioned in a couple of webinars previously. A lot of the investments have gone straight up into the top end of the market, the big end of town, as we say. The top 10, the top 20, your BHPs, your Rios, your big four banks. However, they haven't really hit exactly the earnings expectations that they predicted. So we're looking here as well, of course, 425 basis point rate, the effect of 425 basis point hikes across the last year from the Federal Reserve, which will continue to increase, almost a certainty. Domestically as well, the futures market has pretty much priced in a certainty for next week, the 7th of March, for the RBA to increase the cash rate by another 25 basis points, and possibly another couple going into April and May. So not great looking overall, but hopefully we'll see. The main thing that a lot of investors are concerned about, and I myself am concerned about as well, is that the RBA are essentially just sort of sheepdogging what the Federal Reserve are doing. And they do have a tendency to do that, of course, but I think, particularly, at least my opinion, is that monetary policy should always be implemented as a distinct part of the economy. The US economy is, of course, directly related to ours. They are one of our biggest trading partners, but of course so is China, and of course so is Europe. And we need to sort of identify what's actually going on with the economy and how that's going to be affecting our everyday consumers and everyday people like ourselves. So, and the first one, the final one there is the divergence in growth outlook. So the ISM manufacturing, the product manufacturing index in January, also fell in January as well. It also fell in February. This one's a little bit outdated. The February one just came out in the last couple of days. Also fell again. So manufacturing headwinds continue to increase, particularly in the US, which of course, as I mentioned before, has a direct impact on us. So I mentioned before, I think possibly 2 or 3 weeks ago on our previous webinar, that key support level on the ASX 200 of 7,400 points. Going on that inflationary concerns, those threatening near-term trends, we've broken past it. I'm sure a lot of our clients and a lot of our webinar viewers are a little bit concerned about that. Nothing to be really concerned about. We're currently sitting about 72.75, I believe. That chart is, as I said, about a couple of days old, but it is threatening that near-term trend. So essentially what that means is you can see that China reopening stage there hitting about the 71.80. We peaked quite high quite high, almost at 7,600, which was very, very close to ASX 200's all-time highs. Bit of an overreaction. So this is a little bit of a sell down, a little bit of a capitulation, which is okay. It's not necessarily the end of the world, but however, there still may be a little bit of a short-term headwind going into the trading in the next couple of months. So this was a big one. I wanted to put this slide in here because a lot of my clients were asking, particularly over the course of the last couple of months. Consumer discretionary and IT were actually the best performing sectors on the ASX, as you can see on the table on the right hand side, which was clearly provided by Market Index, which are a very good website. You can take a look at them as well. But consumer discretionary stocks, will they persist? Look, honestly, not necessarily. We've seen this, and we've noticed that it will be primarily considered as a little bit of a dead cat bounce. Consumer discretionary stocks as a whole generally underperform the index during a recessionary period, and we've seen this particularly in a lot of the earnings announcements that have come out over the last couple of weeks. You know, Adair's, Harvey Norman was also another big one that's underperformed, and there are not to say that the entire sector is completely a dud, of course not. And I've always maintained this. It doesn't really matter what sector that you're involved in. There are always stocks within the sector that will outperform the index, particularly based on, of course, and that's why we employ a bottom-up approach, because there are always stocks within the sector that will outperform based on the fundamentals of the company, not necessarily the sector as a whole. Of course, the sector outperforms generally when there's a bull market, but the condition is when the market is not necessarily performing, where do you invest, right? So that's exactly where we're going on to, right? Usually, and as always, historically and hopefully going forward, unlocking the power of gold as an inflationary hedge. And you can see there, you know, we've got a bit of a pros and cons little table there. You can see pros, defensive asset, you know, complements equity and bond exposure. Sure. As I said, historically performed well during recessionary period and that inflation hedge, right? Cons, does not necessarily generate cash flow or profit. That's true for physical gold bullion. Physical gold bullion as well is also a lot of our investors do tend to hold a bit of physical gold, but nowadays, you know, the cons for actually holding physical gold tend to outweigh possibly holding a potential ETF, right? Because of course, when you're holding physical gold, you have to pay for storage costs, you have to pay for, of course, the opportunity cost of not actually generating any revenue from that, and of course, there's the opportunity cost of not being able to invest in actual miners. Tends to be volatile. Yes, that's quite true. We have seen over the last 12 months, gold has been quite for quite a inflationary hedge. It has been quite volatile. So that's why that inflation hedge is, you know, can be a little bit of a concern. You know, during February, during the initial Ukraine Russia conflict, gold peaked at about $2,100 per ounce. Then it sort of traded within a range of about 1650 to 1750 for quite a long time, for about 6 months. Now we're sitting about that $1850 mark. And the reason for investing in gold currently, you know, as the vast majority of our investors will know, as that inflationary hedge, right? Particularly in periods of high inflation, which we currently are in now. And I think the market is currently considering, as I mentioned before, despite inflation figures coming out slightly lower in the Australian economy than expected. Overall, in the medium term, particularly within the domestic housing market, which I've mentioned numerous times before, that inflation number will not drop within the short term. Okay, inflation is here to stay, so therefore you need to hedge against it, right? That's number one. Gold is a finite resource. Of course it is. There's only so much gold in the ground, right? There's only so much we can dig up. Hence, it generates value, right? Less supply equals higher value. And as I mentioned before, you can quote me on this, and you can quote basically any other investor who's been invested over the last couple of years or who knows anything about the market. Gold during periods of high inflation, particularly during recessionary periods, do provide a potential hedge, right? So going forward, right, this is how we're able to help our investors, moving into more conducive sectors for growth, right? Contrarian plays. Nobody really looked at gold over the last 6 months. Everyone sort of avoided it, but we had a couple of great recommendations. We have our very comprehensive mining portfolio, which is I'll touch on a little bit later, that has done about 30% year to date. I think over actually 30%, and particularly a few of the stocks within that mining portfolio were gold stocks, right? But the reason for that performance was not necessarily just because we held it and left it. They were recommended at perfect prices, right? At better prices, at undervalued prices. So for our webinar viewers currently today, right, I don't want to touch on this too much because I've mentioned it a couple of times before, and this necessarily isn't my job. But the value where you generate this is from that diamond membership that you can see on the right hand side. You've got access to our daily finance report, which we send out before market, pre-market open, where you can utilize that information, essentially give you an update if you weren't able to see what's going on in the market the day before. Also gives you a general update as well on the international markets, seeing where commodities are traveling, etc. And of course, access to our 4 portfolios, the income, growth, mining, and the ETF, and as well as our technical analysis software tools. All right, that software it is not the most difficult. I've seen quite a lot more difficult softwares to use. It's actually quite useful. It's quite user friendly, and it actually helps a lot of our clients identify buy and sell points as well, which is great. And of course, you've got our account manager. Sorry, your account manager, and of course, you get a portfolio review. You get a couple of those per year. With either myself or with somebody else, hopefully with me. I've had some good reviews. You can check them as well. But essentially what we try to do there is rebalance your portfolio, identify, as I said, sectors that you may be underperforming in, some sectors that you might be overperforming in, and you might have to take a profit, right? Or you might want to, right? These are all the questions that you're able to ask, and we can go from there. So the point of the day, right? The top 3 picks to beat inflation, right? I say this as top 3 picks, but these are currently these are the top 3 that we are currently looking at within the gold sector, outside of the ones that a lot of people tend to look at, right? These are trying to give you new ideas and something that you may have not heard before. All right. So Newcrest Mining, everyone's heard of that one, right? What are you talking about, Marcos? He's full of it. No, but Newcrest Mining, of course, the one of the biggest gold mining companies on the ASX, right? Had a pretty good year so far, right? Dividend yield of 2.74%, which is pretty great for a gold mining company. I believe Northern Star and a couple of others are sitting about that 1.5%. Pretty good, right? But essentially, remember, gold is always an inflationary hedge. You're not buying into these stocks for a dividend yield. You're looking at this for an inflationary hedge, right? But they have a diverse portfolio of operations. And you can see here, then a lot of people think that Newcrest is primarily just a Western Australian jurisdiction. However, they've got quite a lot of diversification, right? You can see there, they've got quite a diverse asset pool, right? So their Cadia deposit, right, which is actually in New South Wales, I believe, about 560 to 620,000 ounces of gold, not bad, right? The one that is actually in their Western Australia province is the Telfer Havieron jurisdiction, that mining tenement there. It's got about 400,000 ounces of gold, pretty good, right? So essentially what this graph is trying to identify is that they have a diverse asset base, okay? And I've had quite a lot of my own clients ask me, what happened with that Newmont offer? Yeah, I know. For all those who don't know, Newmont, which is a North American-based gold miner, pretty much the biggest gold miner on the planet, offered a takeover offer to Newcrest about a month or so ago, and that fell through. Okay, it's not necessarily a bad thing. In fact, it's actually quite a good thing, because the fact that a Western Australia jurisdiction, an Australian-based gold miner, attracted a company like Newmont is quite good. And they've actually tried to take over Newcrest previously. And Newcrest have been quite prudent in terms of their thinking. Particularly the board essentially just said that the offer did not satisfy maximum shareholder value, right? Which is great. All right. A lot of particularly miners, as soon as they see a takeover offer coming through, they tend to jump at it straight away. That's not necessarily what you want to see, particularly for a company with a reputation such as Newcrest. It was a little bit of an opportunistic bid, particularly because Newcrest has come under, of course, the same amount of headwinds as a lot of other miners, particularly in Australia, particularly when it comes to costs, right? Rising wages, lack of skilled supply in Western Australia, rising oil prices, the list goes on. Everything goes up, and that, of course, contributes to an increase in their all-in sustaining costs. So, of course, the share price did drop a little bit. But, however, the capacity for companies such as Newmont to take advantage, or at least show interest in an Australian-based gold miner, that uplifts the general sector as a whole for Australian miners. So we're quite positive about that. All right. There we go. So as I said, the total gold production for the half year for 23 was about 1,039, 1 billion ounces, I should say, 1 million ounces of 1 million ounces of gold. That's a 25% increase from the previous corresponding period. All right, and that's a statutory profit of 293 million. Pretty good. What I also like about this as well is that they utilize that profit, particularly not just in the first half, but also in the previous second half of 22, to actually pay off their credit facility that they had of the tune of 173 million, right? Which is really good. Okay. The main concern going forward, of course, during into 2023, particularly with miners and particularly with tech stocks as well, you have to take a look at their long-term debt, the ability to facilitate that debt when interest rates were zero. Sure, that's okay. But now when you're paying about 6, 7, 8% on corporate debt, the capacity for a lot of companies to be able to facilitate that debt, of course, is a lot less. So Newcrest paying down a lot of their credit facilities is a great thing to do. And they paid an interim dividend of US 15 cents, which is pretty great, and a special dividend of 20 cents, both fully franked, which is great. Okay, so that's a total of 35 cents per share, interim and special dividend, right? All-in sustaining costs of approximately 1,089 per ounce. That is US. It is always a little bit confusing, particularly with gold miners. Some companies quote their statistics in US dollars. Some people quote them in Australian dollars, but those ones on the left-hand side are in US dollars. Okay. All right, and they've got their Cartier expansion. It's a two-stage plant expansion. It's going to be 35 million ton per annum, commenced in Q2. All right, we're looking forward first ore production, I should say, in Q3 FY23, which will be in about 6 months from now, which is pretty great. Okay, and also a feasibility study for Cartier's execution, right? Expanded and looking at there. So NPV, net present value of 1.4 billion over a 16-year mine life, right? Really good feasibility study. I don't take too much credence in pre-feasibility studies, to be honest, but these values are quite good. And the better thing is that these NPV and these feasibility study values are actually generated based on the costings that they're experiencing now. And we've seen this particularly the problem that we've seen, particularly in the last, say, 12 months, say with the iron ore sector, is a lot of companies, a lot of miners who are looking to expand to production were quoting their feasibility costs on a cost basis that was during COVID-19. Of course, it's not going to be that. And then we've seen a lot of cost blowouts for pretty much all miners, particularly with their capital expenditure. So having this feasibility study locked in now is actually a better thing rather than a negative thing. Okay, hopefully that makes sense. All right. As I said, any questions? If I'm speaking too fast, go ahead and feel free to ask. And yeah, this is just quite a little graph as well for their copper production as well. Gives you a bit of a diversification as well. We're seeing a lot of high demands, particularly out of China as well, coming out of the copper production as well. Taking a more stringent look, particularly at their real estate sector as well, which has been hemorrhaging over the last few years. All right, Newcrest. Look, nothing to cry home about. Newcrest is up 9% year to date. I think it's actually up to today as well, which is pretty good. And look, we have particular target prices as well for our members that we provide. These are always fluid, of course, but we utilize our own software and we provide target prices to our members that they can actually utilize, so they can have a bit of confidence when they're buying and selling and going from there. So the next one that I wanted to talk about, this one's probably not one that anyone has really spoken about. It's quite an interesting one. It's kind of like a little bit of a degree, which I've spoken about before. However, this one is called Emerald Resources. ASX code is EMR. They focus on the Outsmart gold project in Cambodia. Okay, a lot of Southeast Asian projects are actually, they tend to be seen as a bit of a tier 2 jurisdiction. However, the vast majority of GDP for these countries actually is generated from mining, and they have massive support from their governments as well. So the Outsmart project. Oh, and they're currently producing as well, which is good. Production guidance for FY23 is 100,000 ounces of gold, all right, for 2023. Okay, open pit mining, standard. Mine life 7 years with potential of increase, okay. First production there, as you can see, was in June 2021. Okay, so it's not like it's a explorer that has 5 years to go. They actually are producing and they're making money, which is good, all right. And all-in sustaining costs predicted for 2023. That's the key point that I want to touch on, is sitting at about 810 US per ounce. Okay, and the reason for that, right? Again, while a lot of these Western Australian jurisdictions and a lot of these Western Australian mines, of course, do boast support from government and do boast support from the local community. However, costs are quite high. Western Australian miners do get paid quite a bit. So that's something that you have to take into consideration, because all those things contribute to all-in sustaining costs. In other jurisdictions, those costs are indefinitely lower. Okay. So this gold exposure, as I said, 111,000 ounces approximately produced since September 2021. All right, so that's pretty much just over about 14 months ago. Okay, at an all-in sustaining cost of 768 per ounce. All right, I'm not sure if you know much about gold mining, but that's pretty insane. The fact that they're able to produce per ounce of gold for 768, that's essentially a gross margin of over about 60% per ounce, which is insane for gold. Okay, and which was pretty interesting. I wanted to put this one in there as well. They did a takeover of Bullseye Materials Limited. That was an Australian asset. It's in the Bungarra mineralized zone in Western Australia, and that's just of course a prospective tenure, but pretty interesting that they're able to see and utilize a bit of merger and acquisition potential as well going forward. So I really like that. A lot of, particularly when gold miners tend to get up, they get into that sort of middle portion of the S curve, they tend to start paying out a lot of money. They tend to start paying out special dividends, things like that. But utilizing that capital for potential for further mergers and acquisitions is always a good thing to see. So we're happy with that as well. Okay. And yeah, this is just a quick timeline. Of course, they're looking at Q4. Sorry, that was the upgrade as well. And they're looking at further drilling results as well, and resource updates. So essentially, extension of mine life and maintaining that cash flow going forward. And Emerald is up about 13% today, as you can see there, just on the right-hand side. It has dipped off a little bit, but that was pretty much consistent with quite a lot of other gold stocks as well. You know, due to a little bit of a dip in the gold price, but that has since that chart was made, that has since gone up. Okay, and the last one I wanted to touch on as well, Resolute Mining. This is a little bit more of a well-known stock, particularly because it's in Africa, and it's one of the bit of a contentious debate. But we'll talk about this in a little bit further detail. Okay, so Resolute Mining operates, of course, in Western Africa. All right, their two flagship projects are the Syama gold mine in Mali and the Mako gold mine in Senegal. Senegal is a bit of a smaller operation from memory, but of course it is closer to port, as you can see right there next to Cote d'Ivoire. But a geographic diversification. People think, look, not necessarily saying that Africa is the best jurisdiction when it comes to mining, but as I mentioned before when I was speaking about emerald resources, a lot of the times, outside of the fact that costs are quite low, these economies are inherently well, not necessarily reliant, but they are very, very supportive of mining. You know, if you take a look at, say, Namibia, which you can see on the bottom of in South Africa, Namibia, 10% of their GDP is actually contributed by mining, uranium mining in particular, right? Not that I'm talking about uranium in this webinar, but all these countries, I should say, particularly in Western Africa, a lot of them are contingent on a lot of gold miners as well. And there have been quite a successful track record of gold miners operating in Africa. So Resolute in particular, they have quite a strong track record. They are a producer as well with both of those mines, and I'll touch on that a little bit here. Okay, so you can see here, they've got a sulfide and oxide. I really don't want to bother people with the differences between sulfide and oxide, but essentially sulfide, I'll switch it around. Essentially, oxide is essentially a molecule, a mineral that is has oxygen apparent in it. Essentially, that means that with oxygen being more prevalent within the mineral, there's more of it in the ore. So it's easier to mine, it's easier to refine. Sulfide is a higher grade, however, there's less of it. Okay, so they're able to generate a bit of a higher revenue for that. Okay, that's essentially the main difference. So 5 consecutive quarters of incremental production, right? That's fantastic, right? Essentially, that means higher consecutive production, more money, right? The 9% increase in Syama oxide production as well is something that we're really good at. We're really happy with, and the Mako production increased by 2% as well. They did a bit of configuration on their ball mill there as well, and you can see here the all-in sustaining costs did increase slightly, okay, but I can guarantee you. If you compare these costs, particularly to a lot of Western Australian jurisdictions and a lot of Western Australian miners, that percentage increase is not that high. They went from about 1,200 to about 1,450. That has come down a little bit since then, but the main reason for that is similarly to the reasons that I mentioned before, particularly because, you know, high skilled labor, all those sorts of things in Western Australia, right? And you can see here, gold production from Syama totaled about 200,000 ounces, right? And as I said, quick recap of what I mentioned before, you can see that the oxide, Syama oxide, comes at a lower cost because there's more of it to refine. It's easier to refine. All right, and the Mako is 117,000 gold production, so total 350,000 ounces of gold, right? Nothing to be sneezed at, okay? And Resolute Mining price action, pretty good as well, right? And this is why I think a lot of people are starting to garner quite a bit more interest, particularly in gold stocks, because they're just starting to come up, right? You know, especially after the tumultuous year that they had last year. Is it the right time to buy, right? And these are things that we can help you out with. So going forward, I just wanted to quickly touch on what our portfolios have been doing. All right. Obviously, we've taken out the ticker codes because that's only for us to know. But our income portfolio to date has returned 17% year to date. That's only including capital growth, by the way. That's not including dividend yields. Our growth portfolio has done 36% year to date. Happy with that. And our mining portfolio has returned 16% year to date. And the best part about this is what I wanted to mention is that, well, we've actually revealed, or we've actually given out our high conviction buys to our members, and we've got a really good one that has an ex-dividend date coming in the next couple of weeks with a 17.5% dividend yield. Pretty much arguably the best stock that we recommended over the last 6 months. We only recommended them in October last year. Done quite well, and their ex-dividend date is coming up quite soon. And that's probably our highest conviction buy. And we're quite happy for any of our webinar viewers that come on today. We're able to give that to them. But you know, as I've mentioned, you know, the approach, it's not necessarily the stock specialist approach as a uniquity of the markets. It's how the market should be operating as a whole, right? Because in order to be, at least my philosophy is, you can feel free to disagree with me in the comments, but in order to be a successful investor, you by definition have to be doing something different from what the rest of what everybody else is doing, from what the rest of the crowd is doing. That's the, of course, definition of success, right? But what I do like as well, in terms of our analysis and what we provide, everybody can tell you when to buy a stock. Yeah, of course, when it's low, buy the stock. Yeah. But what we also specialize in and what we try to prioritize, of course, is when is an okay time to sell? When is it all right to take profit? When is it okay to manage your capital? Is it all right to take a bit of profit on Telstra, put it into something else, right? Those are the questions that the vast majority of investors are looking to answer and are looking for guidance on. And we've had a lot of success on that. I've had a lot of success on that with my clients, and we've been, you know, more than happy. And it's honestly the vast majority of our clients have garnered great success from that, and we're quite happy with that. So look, if that sounds pretty interesting, of course, let us know. But this is how we're focusing our sector analysis in 2023. Okay, our defensive sectors, right? Particularly, as I mentioned, healthcare. I mentioned healthcare a couple of times in the last couple of months. Healthcare, unfortunately or fortunately, if anybody listened to me, then it would be fortunately. But unfortunately, healthcare stocks have taken a little bit of an uplift now. So that may be a bit of a spurious bit of trade. But utilities, right? Your Telstras, your Spark New Zealands, your TPGs, they're always good holds, right? Those are defensive sector utilities that are able to maintain consistent growth, basically based on their inelastic demand. Okay, essentially what that means is, despite the rising cost of living, right, you're not going to switch your phone off, you're not going to switch your internet off, etc. Right? Inelastic demand. Okay, consumer goods, consumer staples, very similar prospectus, right? Your Woolies, your Coles, you're not going to stop eating because you can't afford it, unless you really can't, right? God forbid. Okay, this is another one that I wanted to really touch on, because I did mention this quite a few times before, and as I said, we saw this particularly with the big stocks, right? Your BHP reduced the dividend, Fortescue reduced the dividend, a lot of other big miners reduced their dividends. It's about predictable income, dividend stability. There's nothing, of course, miners do when they increase their profits, they do have a tendency to increase their dividends as well. However, it's the capacity to maintain that dividend. And that dividend stability is hugely important, particularly for our clients with SMSFs, right? You can't have a good year, you know, with particularly, of course, generating your income via dividends, and then the next year it reduces by 50%. It's horrible, and we don't want to see it happen. And unfortunately, I've seen it happen quite a lot of times. So with this slowing demand, I have mentioned this quite a few times as well, just on base metals and of course precious metals, still going well. Like I said, a lot of this is contingent on the Asian markets, particularly in Europe as well, that increase of demand, and in North America as well, who slowly but surely increasing into that precious metal market demand. And they're going forward. Look, it will be at a slightly slower pace than everybody else due to, you know, regulatory approvals and things like that. But North America is also not one to be counted out as well. All right. So as I said, you know, overall, I hope everyone enjoyed something. You know, hopefully you got a couple of new ideas, something to take a look at least, at the very least, chuck on your watch list. As I mentioned, if you've got any questions on any of this, feel free to give us a call on our main line. Visit us at stockspecialist.com.au, or you can give me a call as well on 0459 934 889. That's just my number there. You know, my job, of course, is to help our clients as much as we can. You know, we're pretty much helping our clients 24/7, and you know, any questions that you foresee, you know, we've gotten quite a lot of interest, particularly in today's webinar. So thank you so much, everyone, for taking the time, and hopefully we'll be in touch soon. So thank you very much. Enjoy the rest of your day.